one thing I found of interest, though, is that the precious metals, if you look at gold, for example, it actually tends to move with the actual CPI, not the gimmick CPI. I have my index that, again, estimates the way it used to be. One thing I did was I set my index the same as the government's index prior to 1982. It's the same level. Just after 1982, my index continues going the way the old CPI would have gone, where the government's number goes with the new CPI. And if you look at what happens over time, where the series split, the government CPI sort of flattens out on a relative basis. Mine goes up exponentially. And I plotted that against gold, the price of gold, just the index levels and the price of gold. I didn't even have to change the scale, which shocked me, pure coincidence. But if you look at the headline CPI index, its base year is 1982-84 equals 100. I have the same base year on mine. And if you go back to 1971, when Nixon floated the dollar, back then the CPI averaged about 79, again, against its 100 base. But the price of gold is also at $79 an ounce. So what you find out is you plot them over time, the price of gold starts following my index higher as we get past the government's number. The government's number again goes off like this. The line goes up like this, and the price of gold goes up like that. The relationship's not perfect, but it's still holding up over there. Now, right now, the gold is artificially depressed. It should be over $2,000 an ounce. You've had some very unusual things happening in that circumstance, but over time, give it time, it averages out at the same level as the actual CPI. It's a hedge against inflation, maintains the purchasing power of your assets, and it's been doing that for millennia. You could buy the same amount of you could buy a loaf of bread in ancient Rome for the same amount of gold that you could buy a loaf of bread for in New York today.